In this video, I'll be covering how to use a multi-family home as a multi-generational home in order to reduce your down payment burden and your monthly mortgage bill. Hey, my name is Rajesh. I'm a direct lender based in Los Angeles, specializing in 2 to 8 unit multi-family buildings. Story time. So this family, the husband earned $79,000 a year. The wife earned $55,000, and they were a multi-generational family. They were looking to buy a 4-unit building, occupy 2 units, and rent out the other 2. I actually convinced them to get a slightly bigger first unit so that we could use the income from the other 3 units to qualify for the purchase, and not just to qualify the income for the purchase, and not just use 2 apartments, because if they're living in 2 units, we could only use rental income from the other 2 units. But if they're living in 1 unit, we could use the rental income from the other 3 units. And so that was the strategy we came up with. And they were looking at a place in Redondo Beach, and the place, the rents over there on average are about $2,500 for a single unit. So this is what their income ended up looking like. The wife's father-in-law made $2,000 a month, well, $1,935 a month to be exact, and the mother-in-law made about $1,235 a month. They had a yearly income of $172,000 a year. That was their income for 2025. The year before, they made about $165,000 total, and the year before that, they made about $135,000 a year. And there was confirmed raises, so we are going to include that in there. And the monthly rents were about $7,500 a month total from the 3 other units if they got that fourplex and lived in 1 unit, owner occupied the 1 unit. So their qualifying income was $239,000, almost $240,000 a year. The loan type was an FHA loan. With an FHA loan, they would only have to put 3.5% down, or a total of $46,000. But between the 4 of them, they had that. And if they'd gone conventional, they could go actually slightly less on the down payment, $33,000. But because of the high amount of mortgage and private mortgage insurance, which would have been about $1,500, $1,600 for the whole year. Let's see here. No, for the whole month, every month, we're actually looking at a higher monthly payment, and as a result of the higher monthly payment, their maximum home price went down. That's because for this story purposes, I'm going to say they had 0 debt. And their interest rate was closer to 6.375. They all had great credit scores. So we qualified all 4 of them together based on all their incomes, plus the income from the rents, or rather 75% of the rental income. And we saw that their down payment was about $32,000. Now they had about $45,000 to $50,000 to cover the closing costs, so they were able to get 6.375 interest rate. But let's assume they did not have that. Let's assume they did not have the cash for the closing costs. They only had enough to cover the down payment. Well, at a 6.875%, they would have received enough credit to pay for some of the closing costs, and in the form of seller credits, they could have covered the rest, like maybe about $15,000. And on $1 million property, if you're buying $1.1 million property and you get the price lower to $1,085,000, the owner's still going to be happy to sell it to you. You're still getting a loan for $1.1 million, but the extra cash is just being used to pay for the closing costs. That extra $15,000 is just being used to pay for the closing costs, and it's called seller credits. Whereas the seller agrees to a final price of, let's say, $1,085,000, but the sticker price still says 1.1, and that difference between $1,100,000 and $1,085,000, that $15,000 difference, is given to you to apply to the closing costs. So that's what we did in this case. But they did not get a $1.1 million home. The maximum home price they qualified for was $1,025,000. So they ended up lowering the price to like $1,010,000. And their monthly payments were $9,362 a month. That sounds like a lot until you realize about $7,500 of that was being covered by rental income. Okay? So 9362.02 minus 7,500. So they were only responsible for about $1,862. That was their total mortgage payment after taking into account the rental income. But let's say they had occupied 2 units instead of just 1. So now they're getting $5,000 a month, right? 9362.02 minus $5,000. So that means their mortgage payment was $4362.02 a month instead of the full $9362. But here's the crazy thing: I'm going to remove the father-in-law's income and the mother-in-law's income. And that gives us a total income of $134,000. Okay? So let's say $134,000. And they did not, and let's say they went for a single family home. Okay, let's just say they went for a single family home and they still got 3% down. Now their down payment amount is $14,879. Let's just say $15,000, half of what they would have had to pay if they got the 4 unit. But here's the crazy thing: their maximum purchase price drops from like $1,025,000 to less than $500,000. That's the maximum home price that they can get, $495,000. But here's the crazier thing, and this is a conventional loan, not an FHA loan. With an FHA loan, their max purchase price goes up, assuming the minimum down payment. You're looking at a $569,000, $570,000 home versus $1 million 4-unit. But here's the crazy thing: their monthly payment on that $495,000 home is $5,237. Let's just say $5,200 to be even, because it's a single family home. They're not collecting any rents. On an FHA loan, their monthly payments is still $5,200 a month. So that's the difference between pooling your resources together and buying a multi-family home to support multi-generational living versus just buying a single family home without using your in-laws' incomes to qualify. Now, each of you still get your own separate places, right? Because in a 4-unit apartment, one family, the in-laws can live in 1 unit, and the other family, your family, can live in the other unit. And you're occupying 2 units, but you're still having rental income from the additional 2 units. So your purchase price can be higher, and your monthly payments will be lower. So that's the benefit of pooling your resources together and getting a multi-family home to use as a multi-generational.